Money FM 89.3, best of breakfast. The bigger picture, only on Money FM 89.3.
Good morning. Welcome to The Bigger Picture. And it's nervous times for markets as we count down towards Liberation Day, when we will hear more about where tariffs and how they will be targeting various trade partners of the U.S. And in the meantime, we've got S&P 500 closing slightly higher overnight after briefly touching a 6-month low. So lots to navigate as we wrap up Q1 and head into Q2. And to help us out, we've got Heung. He is the Senior Investment Strategist at Standard Chartered Bank. Ray, good morning. How are you doing today?
Very well, thank you. Thank you for having me.
Yeah, great having you on. So let's start first with a bit of a reflection on how the first quarter went by. So how would you describe it based on how it met your expectations?
I think it was a so-so quarter, overall. We definitely have seen S&P actually hitting new highs and then retreating about 10% so far. And US 10-year has actually broke through 4.6, 4.7 and then trended down again. And so I think, overall we have quite a bit of volatility come back into the marketplace. But I think importantly, investors would need to distinguish between signal and noise. And in particular, when we're talking about the noise that has been go through in the marketplace, in particular, let's say, that we look at GDP now, Atlanta GDP now, has been causing a bit of a problem in the marketplace. We think that is probably a one-off item, because it was some very heavily import situation that actually caused a one-off situation for GDP now to get a very negative read. But our base case is that it's still a soft landing scenario. In particular, we are talking about a still very resilient job market in the U.S., and therefore, with volatility, you just have to continue to have a very balanced portfolio. That's what we continue to believe in. So overall, I think we still would be slightly positive on equity. We have a slight overweight, despite we have trimmed down a bit, but we think that, growth is still in the card for the global situation.
Let's unpack that a bit. So like you pointed out, in the space of one quarter, the S&P 500 hit a new high and then went to so-called correction territory, dropping 10%. So quite volatile times. And of course, in the backdrop is the tariff potential impact on the global economy. And you've kind of outlined you're still quite overweight on equities, at least in the US. Which parts of the universe are you looking at more closely?
Overall, we slightly overweight equity. We actually did trim a bit compared to last month. In terms of overall overweight position. We now have a little bit more balanced view between US and Europe. Previously, we were slightly overweight U.S. versus Europe, and now we are a little bit more balanced. Largely because of, as you already alluded to, the Liberation Day. We think that tariffs headline will continue to hit us, and therefore we will be facing a little bit more volatility for the U.S. side at the least. Europe, on the other hand, Germany has actually been trying to break through the debt brick. But we think that Europe is not just one nation, right? It's actually a number of nations altogether. So one country doesn't mean that, every other country could do the same thing. And so for us, Europe seems a little bit overstretched in terms of positioning. We do understand that, momentum has changed a bit. But we do think that overall, both regions would warrant an overweight for us. And in particular, I think Europe overstretched in terms of valuation. It will be a buy on dip opportunity for us.
So Europe buy on the dips, because that's a question about valuations, because some of these big names have kind of retraced or pulled back to some degree, especially in the AI space. How do you play this AI theme when you're looking at all these names right now? We
also very much like that theme altogether. I mean, having said that, that also brings us to another angle of looking at this AI theme, in particular, if we bring us closer to our home in Asia, whereas China actually has been benefiting from that so-called cheaper DeepSeek model that we can actually do this AI angle. So for that, we are slightly overweight China on the back of this theme. Altogether, undemanding valuation, and together with earnings momentum is still positive. So if we are talking about AI, I think Chinese equity, especially the offshore Chinese equity, would be a good way to play that.
Okay, we've been hearing some talk, at least increased optimism around the Chinese market. How are you approaching China right now, especially when you look at the various sectors?
We are still pretty much stick with the offshore Chinese market. In particular, you're talking about A versus the so-called H and Hong Kong stock market. So one way or the other, we prefer sector which are a little bit more tech inclined, less on state-owned inclined sectors. I think those are the themes that we continue to push for. But like I said, undemanding valuation, earnings momentum are on the rise. I think definitely China would be an opportunistic buy for us.
Okay, so lots to watch out for on the AI front and those markets. And turning our attention to bonds, fixed income. So you've got a bit of a optimistic view on where growth is. At least you're not looking at a recession. How does that shape your view on how to enter or approach the bond space?
I think the first thing to remember is, yes, we are not expecting any recession situation over here, and therefore our inclination is slightly more towards growth. And by that, by definition, we'll be overweight a little bit more on the corporate sector versus government bonds. Government bonds tends to be even more rate sensitive in comparison to corporates, just because, you have a bit of yield premium that you can add as buffer, right? And within the corporate sector, generally we like high yield still. Again, going back to the theme that we spoke about, the growth of the economy and things like that, we're expecting default rate to be kept relatively low. And so from a risk-adjusted angle, I think high yield bond will definitely give investor a little bit more juice.
All right, corporate high yields, that's where you are favoring. And talking about diversification, where does gold enter the picture? Because we've seen quite a good run. And I think in some markets, gold has actually outperformed equities, at least in the past 2 years.
I think we still have a slightly tilt over gold in terms of overweight. We still like the idea. But I think one of the situations that we need to bring home is that seemingly the buying spree has been relatively strong. So a buy on dip opportunity. I think fundamentally, if you look at the flow, the central bank has always been one major buyer in the marketplace. So I think that would not change. And at the same time, if you're talking about fear of a recession risk in the U.S., stagflation risk in the U.S., gold is always a good hedge. And so for us, it's a buy on dip opportunity for gold.
All right, plenty of tailwinds for gold. And of course, with the backdrop of all the uncertainty around trade and global tensions, so that is something that could help support it further. We've been in conversation with Ray Heung. He is the Senior Investment Strategist for Standard Chartered Bank. Ray, thanks so much for your time and insights this morning.
Thank you.
All right, great chatting with you. Stay with Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.